I started trading options 4 years ago as a way to create an additional stream of income. If done correctly, trading can be highly lucrative. If done incorrectly, it could mean significant losses. As with everything new, it's inevitable that we make mistakes. My journey of learning to trade was no doubt filled with my fair share of it. There's nothing wrong with mistakes. Each one teaches us what we should or shouldn't be doing and helps us improve. The problem comes when we don't learn from them, when we are not humble enough to listen, when we are too arrogant to accept that we were wrong and continue to double down on our incorrect biases. My arrogance cost me $50,000. Losses are unavoidable in trading, even more so during the learning process. But my loss could have been way less if I had learned my lessons the first time. There were multiple occasions when I knew I was wrong, but did not right the wrong. I forged on, hoping that the situation would turn around and the trade would be profitable again. For those that didn't work out, it was too late. My delayed remedy compounded my mistakes and culminated in a $50,000 loss during a market crash one day. It didn't matter that I had the guidance of great mentors and a great community to learn with. It all came down to whether I was humble enough to accept the lessons that I had to learn. By now, I am truly humbled, and I want to share with you the 4 trading lessons I've learned the hard and painful way. Never trade leverage stocks. I was trading leverage exchange traded funds like SOXL, TQQQ, and SPXL. A leverage exchange traded fund, LETF, is a security that uses financial derivatives and debt to amplify the returns of an underlying index or other assets it tracks. While a traditional ETF typically tracks the security in its underlying index on a 1-to-1 basis, an LETF will typically aim for a 2-to-1 or 3-to-1 ratio. While leverage ETFs offer potential for significant gains that exceed the traded index, they also mean significant losses that exceed the traded index. As they are leveraged, they are also more volatile. Their volatility made selling options on them attractive because of the high premium. But volatility was what killed me in the end. I was aware of the risks, but I thought that I could somehow get away with the benefits while avoiding the risks. The market bailed me out for the initial few trades that went against me. And so I kept going until eventually the market crash caused the 3x leverage ETFs I was trading to drop 3 times more than their underlying index. It's not inherently bad to trade a leverage ETF if a trader is experienced and disciplined enough to manage the trade and the risks. It only becomes a mistake when coupled with other bad practices like not diversifying your trades, overtrading with margin, and not cutting loss. Every one of which was an offense I committed. A leverage ETF, unfortunately, magnified the impact of my bad trading practices. Never go all in on one stock. At some point, I decided to go all in on one particular leverage ETF that offered some of the highest premiums I've come across. All was good for a while when the trades worked out in my favor, until they stopped working out in my favor. This was to be expected, but somehow I ignored that possibility and buried that thought every time it surfaced. Because I held all my positions in one ticker, when the stock fell, my entire trading account fell with it. And because I didn't diversify my trades across different stocks with different degrees of correlation, I felt completely beholden to the price movement of that one stock. Never use margin to trade when you don't have the cash to back it up. To understand margin, we first have to understand leverage. Leverage is a ratio that shows how much larger a trade can be compared to the amount of capital deposited. It allows traders to control a larger position size with a smaller amount of their own funds, potentially leading to larger profits or losses. For example, with a 10-to-1 leverage, a $1,000 deposit can control a $10,000 position. Margin is the amount of money required as collateral to open and maintain a leverage position. If a broker requires a 2% margin, a trade of $10,000 would require a $200 margin. A higher leverage means a lower margin requirement and vice versa. Because you do not need the full amount of money to fund a position, margin allows you to borrow money from your broker for an interest. While I was aware of the risks of trading on margin, including amplified losses and margin calls, I proceeded to use it several times. I had a few close encounters with huge losses when the trade moved against me, but each time the market bailed me out when it bounced back higher. My wake-up call came during the market crash when I came close to getting a margin call. Margin calls happen when the value of your positions decline sharply, and if you don't add more funds, your broker may force liquidate your assets. When I realized the gravity of the situation, I remember feeling trapped. I was using borrowed money to trade. My positions had dropped double-digit percentage values, and I had no available cash to deploy readily to top up my liquidity. If the value of my positions dropped by $1,000 more, I would get that margin call. $1,000 was not a lot of buffer, considering the volatility that day. It was psychologically a very painful place to be in. And without cash, I had to transfer some long equity positions from my investment account to bring up that liquidity in my trading account. I typically don't mix my accounts for long-term investments and short-term trades, but I had to break that rule that day. Never let your trades turn into investments. Never disrespect the cut-loss point. There's something about losing money that I wasn't able to handle for a long time. I knew losses were inevitable in trading, but I wasn't willing to accept it. I stubbornly wanted to win every trade. As a result, I held on to losing positions. Short-term trades turned into long-term investments I never wanted. All along, I was hoping the situation would turn around, for the temporary paper loss to turn green. The market had bailed me out before. It could do it again. Because I was trading leverage ETFs, it meant more trouble for me. Leverage ETFs are not designed for long-term investing. Because they rebalance daily to maintain their leverage ratio, returns are eroded over time, especially in volatile markets. I held on to my leverage ETF for almost a year, and unluckily for me, it was one of the most volatile one-year periods in my 4-year trading career. Because I overtraded, used margin for my trades, went all in trading only one leverage ETF, and did not cut my losses early, as I watched the market crash further during the market open that day, I felt a growing psychological pain. It grew more intense the more the market dropped, until I reached my breaking point. I closed all my positions and realized a massive $50,000 loss. What came after were mixed feelings of sadness and relief. I was sad for losing so much money, but also relieved that this was all over. All the risks that I read about and close calls that I encountered finally started to take root in my brain. I was beginning to accept the mistakes I've made and the lessons that the market was trying to teach me. I was seriously humbled. Is this the end of my trading career? Definitely not. It felt more like the end of a chapter. I knew that if I started to apply the lessons I've learned and trade properly, I would definitely make back the $50,000 and so much more. $50,000 was the price I had to pay to learn what I needed to learn to truly play the game.